Hey guys, welcome back to the channel. This video marks the beginning of a new course completely free of cost, exclusively on the concept and application of price action trading. The course is designed in an orderly manner from the very basic to the advanced level as we move up the ladder. I have accumulated a good chunk of the information from some of the best trading books, trading blogs, paid courses of some of the famous professional traders, and a few relevant online sites. Also, I have taken a lot of effort to explain each concept in a way that even newbie traders can understand without much difficulty. So, I heartily welcome every aspiring trader to take a ride with me throughout this course. So, let's get started. Traders have always benefited from massive jumps in asset prices, especially during volatile market conditions. So it is our responsibility as a trader to understand these massive jumps in asset prices, or simply the gaps formed in the market, and then learn about them, analyze them, and finding ways to trade them in the market. So what exactly is a gap? The difference between two consecutive candles closing price and opening price is called as a gap. Or simply, a gap is an area of discontinuity in the chart where the price of the asset either falls or rises from the close of the previous day. A gap occurs when the prices skip between two trading periods, that is, skipping over certain prices, and so it creates a void on the price chart. Or simply, these are areas on the chart where no trading activity has taken place. Now you will have a question in your mind, why do gaps occur in the market in the first place? Now there are a few reasons as to why gaps occur in the market. Let us look at the reasons one by one. First of all, gaps occurs due to an imbalance between the demand and supply. The gap up, for example, is because of the aggressiveness of buyers, which means that there are more buy orders in the market. Or simply, the demand is greater than the supply, which will boost the prices to go up. Or in other words, the price will gap up. Similarly, a gap down is because of the aggressiveness of sellers, which simply means that there are more sell orders. Or simply, the supply is more than the demand, which cause the price to gap down lower. So in short, gaps occurs at levels where there is a supply and demand imbalance. The second reason due to which gaps occur are due to the overnight sentiments of the market participants or due to any big news. Gaps usually occur when there is a fresh news or a big announcement that will lead to change in the market fundamentals, usually when the markets are closed. So when such a news spreads, there is a flood of buyers or sellers waiting to buy or sell depending upon the nature of the news. And finally, sometimes the smart money or the big institutions try to skip the important support and resistance level. That is, for example, if they are bullish on a particular stock, they will gap up the price above the supply zone where they could have faced a potential selling pressure. Another important point to note about gaps is that gaps can act as supports or resistances. So in case of a gap up, the gap can actually act as a support zone, and during a gap down, the gap can act as a resistance zone. We will use this particular idea further up in this video. Now another idea which is worth mentioning is the idea of gap filling. Now gap fill refers to the price retracement back to the previous day closing price. Now you can ask the question that do all the gaps get filled? The simple answer to this question is a no. That is, not all gaps get filled. However, 90% of gaps eventually get filled. The problem that you will have if you are making trades thinking that a gap will get filled every single time is that even if it does get filled, it can take a very long time. While most gaps get filled quickly, some gaps will not be filled for months or even years. So if you are looking to make trades aiming for the gap to get filled, then you need to keep in mind that not all the gaps will fill and some of them will take a very long time. Now, all the gaps are not the same. There are different types of gaps, and actually the gaps are divided based on the context in which they appear. So I'll talk about three of them. Number one is the breakaway gap or the breakout gaps. The breakaway gap means breaking the important support or resistance level or a significant trend line in the form of a gap. The breakaway gap actually appears after the completion of an important pattern like a price in a consolidation range or a continuation or a reversal pattern. So the main logic behind breakaway gap is that the smart money knows exactly where the support and resistance areas are. Let us say, for example, if the smart money is bullish and higher prices are anticipated, the smart money will certainly want a rally. But the problem is how to avoid the old resistance which could trigger some selling pressure. So what they will do is that they will gap up through the old area of supply as quickly as possible as a way of avoiding the resistance. Now, after the breakaway gap has occurred, we have a clear sign of strength. Now, the smart money does not want to have to buy the stock at higher prices because they have already bought their main holdings at lower levels during the consolidation. And they also know that a breakout above the old resistance area will create a new wave of buying in the market. And how can they be sure about this? Number one, many traders who have shorted the market will now be forced to cover their positions by buying back the stocks. And then there will be a second group of traders who will be looking to buy the breakouts. And finally, there will also be traders in the market who may feel they are missing out on a big opportunity and they will be encouraged to start buying. Most often or not, the breakaway gap will not be a trap-up move or a false breakout because high volumes will be supporting the move often. Now coming to the second type of gap, it is a runaway gap or a measuring gap. In this case, the price move have been underway for some while and somewhere in the middle of the move, the prices will gap up. And this type of gap up is called as a runaway gap. So in case of an uptrend, it is a sign of the continuation of a trend. And also in case of a downtrend, it is also a signal that the trend will continue. Moving on to the third type, which is an exhaustion gap. These are generally weak gap ups or gap downs. So it can be a weak gap up to the resistance or a weak gap down to a support. This price action is actually designed to trap you in a potentially weak market and into a poor trade and thereby hitting your stop losses. And most often or not, it will form a false breakout or a false breakdown in the market. Well then, let us figure out how to trade the gaps successfully. There are several ways to leverage gaps in the market to your advantage. In this episode, however, we will talk about the idea of breakouts and reversals with respect to market gaps. These strategies are based on two types of gaps, with the open price depending upon the highs and lows of the previous trading section or the previous session's range. So it can be an outside gap or a full gap. Now this happens when the market opened outside the previous day range. That is, the candle opened outside the previous day high or the low for a gap up or gap down respectively. And the second type of gap is an inside gap or a partial gap. In this case, the market opened inside the previous day range. That is, in case of a gap up, the candle opened above the previous day close but not above the previous day high. So there are three main factors we have to monitor to determine whether the gap is real or a trapped gap. So these three factors are the volume, opening price and the pullback to a particular level. Let's talk about the volume briefly. It is important to watch the volume carefully when determining if a gap is valid or not. So for example, if a stock gaps up, and the volume is also high and also the price remains above the opening price after the morning pullback, it is an excellent sign that the stock can further go on the upside. In addition to volume, you can also make use of an indicator called the VWAP or the volume weighted average price, which plots the average price adjusted for volume on the chart, and it is fairly very easy to make use of. Also, the VWAP assigns more weight to the price points with high volume. To talk about VWAP briefly, VWAP is typically used with intraday charts as a way to determine the general direction of the intraday prices. It is similar to a moving average in that when the price is above the VWAP, prices are rising, and when the price is below the VWAP, the prices are falling. But for the sake of this video, we will go with the conventional approach of following the volume bars for confirmations. Now talking about the time frames, the strategies that I am about to discuss are based on a smaller time frame, that is the intraday time frames, particularly on the 5-minute chart and considering the price data from 2 consecutive days where the gap has occurred. So to begin with, I have to plot the previous day's high and lows and also bring up the volume indication on the chart. Then you have to see if it is a gap up or a gap down, and you have to figure out if the gap was a partial gap or a full gap. Now after finding out these prerequisites, you are ready to take either the breakout approach or the reversal approach. And the most important thing of all, do not trade the first hour after the market open in case of a gap opening, because we need to understand the price range or the price action happening during such a volatile opening so as to implement our strategy with some amount of confidence. As I have mentioned earlier, there are two types of gaps, partial gaps and full gaps. And these can be further categorized to partial gap ups and gap downs and full gap ups and gap downs. So for these four category of gaps, we can actually implement a long trade and a short trade, which will leave us with 8 different strategies to use with. But at this point, I will pinpoint only 4 strategies which has a higher win rate than the other 4 strategies. And let me make this very clear that sometimes the trades won't work out as we have planned, and it is better if we opt to not trade under such situations. Starting off with trading the full gaps. Let us talk about a full gap up, that is, open price of the gap up candle is higher than the previous day high. We have to note here that the previous day high is an important price level which can act as a support level for the prices. It can trigger a buying pressure in the direction of the gap up. So in this particular situation, we have to wait for the prices to form a range during the first hour of the market open, and then if we manage to find a pullback to the previous day high, which is the demand zone here, then we will look for a continuation trade on the upside direction when the price actually breaks above the opening range high or the high that was formed during the first hour of market open. We also have to see if the volumes are favorable or high enough, which will help to strengthen our trade confirmation. We can enter a long trade above the high of the range, and we can keep the stop loss below the previous day high level with a suitable buffer. And in case if the open range high is very large, we can actually enter a trade above the range, keeping at least 1.5:1 risk to reward and placing the stop loss below the highs of the range or below the breakout of the range candle lows. Now you may have a doubt in your mind. What if the gap up is too large? That is, if the price opened far above the previous day high, which means it is far away from any area of support, and in such a case, the probability of the price retracing back to the support level or the previous day high level is very low. So, as a price action trader, we can't initiate any reasonable trades as there is no critical price levels where we can find a trade entry. And of course, if there is any market support and resistance level near the 1 hour range after the market open, then we can take a breakout or a reversal approach based on price action. Other than that, it is better as a price action trader to stay away from such a huge shift from the price level, as the win rate of the trade can be low. I'm not saying that it is not possible to trade such huge gap ups. Of course, it is possible with technical indicators like VWAP, which we will talk about in the technical analysis course. But on the scope of a price action trader, it is better to stay away from such setups. Moving on, let us talk about a similar case, but it is about a full gap down. That is, the price opened below the previous day's low. In this case, the previous day low will act as a resistance level where there could be potential sellers coming in and push the price lower. So in our approach, we will wait for the first hour so that the volatility will cool down, and then if we see a pullback of the prices back to the previous day low, which is a potential resistance level. Now you have to mark the low price of the range so formed during the first hour, and if the price manages to break below this range low with a high amount of volume, then we can enter a continuation trade in the direction of the gap down. We can take a short entry below the breakout of the range low, and we can place the stop loss above the previous day low, or in case if the range is too large, we can enter a short trade with a predefined reward to risk of at least 1.5:1, keeping the stop loss just above the breakdown of the range candle low. Similar to the previous case that we have discussed in case of a full gap up, in case of a full gap down, where the open price is far from the previous day low, which is a potential resistance level, the probability of a pullback or retest back to the resistance level is very low. And it does not make any sense as a price action trader to be trading without a critical price level to rely upon. So better avoid trading when the price does not respect any support or resistance levels. Now these are the two full gap trading strategies that I prefer using in contrast to their counterparts, which are the full gap up short trade and a full gap down long trade. Now the idea to trade the other two techniques is based on the strength of the pullback, which means if the pullback is very strong and breaks through the level with high volumes, then we can think about implementing these two strategies. We can research more about the other two strategies if you are curious enough. Moving on, let us talk about the two partial gap trading strategies. One of the most important points that we have discussed earlier was that a gap can act as a support or resistance level. When price does move in and close the gap or fill the gap, it will often bounce away and act as an area of supply or demand. So there are two potential levels to consider out here. The first one is the previous day closing price, which can oppose the prices. So is the opening candle of the particular day under consideration. So both these levels are potential levels for price reversal. So instead of considering both these levels as separate entities, we will look at them as a zone or area of price action. Now starting off with a partial gap up, that is, open price is above the previous day close but still below the previous day high level. Now when a market gaps up, the gap can act as a support level for any pullback. The pullback tests the gap with lighter volume, which tells us that the price does not have enough legs to get past through the gap or break down below the gap. Instead, the gap becomes a support and there is a potential price reversal possible towards the upside, and any bullish signal that is triggered is our buy entry. So it can be a bullish pin bar or a bullish engulfing pattern, etc. We can also look for a rise in the volumes when the prices starts to rise. We enter long at this bullish signal. That is, we can wait to enter above the reversal candlestick high, or for an even more conservative approach, we can enter when the price breaks above the day's high level formed so far. But this particular approach of entry doesn't make sense if the range high is very close to the previous day high. Then there can be potential selling pressure and your trade can go against you. So make sure to maintain a good reward percentage and keep an eye on the important levels where the opposing pressure could potentially come in. We can place the stop loss just below the gap zone and we can fix a reward to risk of at least 1.5:1, or you can even keep the target as the previous day high level. So the benefit of using this strategy is that gaps fill 90% of time. So this is a popular trading strategy. The second strategy is when there is a partial gap down. That is, open price is below the previous day close, but it is still above the previous day low. When a market gaps down, then the gap acts as a resistance level for any pullback. If the pullback tests the gap with a smaller volume, it tells us that the price does not have enough strength to break through the gap or break out above the gap. Instead, the gap becomes a resistance level and there is a potential price reversal possible towards the downside, and any bearish signal such as a bearish engulfing candle or a bearish pin bar gets triggered, it is our opportunity to short the market. We will also have to check if there is high enough volume associated with this particular move. You can enter a short trade below the bearish confirmation candlestick and place the stop loss just above the gap for safety. Or it is much better if you keep a predefined reward to risk beforehand as a part of risk management. Now these were the two partial trading strategies. The two others are the partial gap up with a short entry and the partial gap down with a long entry. In these strategies also, volume and pullbacks back to the gap regions is the key. That is, if there is a strong enough pullback assisted with strong volume break through the gap zone, then we can think about utilizing these techniques. You can check them out yourself if you want. You can also notice that all the strategies that we have discussed, we were actually taking a trade in the direction of the gap and not against it. And finally, it is up to you as a trader to backtest these strategies on the chart and find out if you can actually implement successfully in your trades. Now that is it for today, guys. I hope you have learned something new. If you have, please do like the video and subscribe to the channel, and don't forget to press the bell icon so that you don't miss out on the upcoming videos.